For more on rates, let's bring in New Edge Wealth Head of Fixed Income, Ben Emons. Ben, great to have you with us.
Hey, Melissa, it's great to be back.
Hey, are we going to look back on this level of the 10-year yield and think this is pretty much the highs for this cycle?
Well, I think we still have some to go here. You know, like if I was looking at technical levels today, if you take from, say, the 2007 peak to the bottom in 2021 and then back up, if you think of the retracement levels, then we've really broken through all of them. So technically speaking, you should actually make all the way back to the top. Now, there is some, I think, some tactical opportunity here. I was looking at TLT and VGLT. They're quite oversold now on short-term indicators. They've drawn down almost like 13–14% from the peak in July. So that may be your tactical opportunity. But I think we have to reckon that a yield at 4.25% was not really reflective of the economy. It may be a yield of 5.25%. And echoing to Tim and Chris's points, like this is a supply-driven rally, but it's also about liquidity. Right? We have quantitative tightening. So last week, for example, the Bank of England increasing quantitative tightening. So there's also a global story behind rates. So I think we may have a tactical short-term bounce here in VGLT or TLT, but it's really the upside of 5.25 on the 10-year. I think that we'll have to look at.
So, I mean, not to play bond market too much, but the opportunity is there for yields to go slightly lower. But then that would, in theory, be the point where you would bet that yields would go much higher because you're actually seeing key resistance 4.75.
Yeah, I think so, Melissa. I think that this 4.5 that was mentioned the other day was just not really holding here. There's too much pressure, you know, just simply by supply. Very simplistic today with T-bill auctions. They don't actually never matter to markets, but they were not that well received. And I think that added to the pressure in yields this morning. We're getting a lot more supply this week, so I think it's more about 4.75 as a key resistance for this short-term technical buy opportunity. But then from there, we have to see how much it pulls back. You know, it depends on data and depends on inflation. If we don't pull back much, then it's really going to be a move towards 5.25. That does look like it.
Hey, Ben, it's Tim. So how much of this, if at all, could be related to government shutdown dynamics? I read your notes. They were fascinating. In fact, it's complex. You say maybe there's a short-term even, funding dynamic for the Treasury because they want to get through a difficult period. They want to have liquidity. T-bill market also, look, in the short run, maybe they're trying to overfund in the T-bill market. As rates go higher, it becomes a lot more expensive for them to finance a deficit that's getting bigger and bigger. And ultimately, they're going to have to lock in some higher rates out the curve. Attack this any way you want because it's fascinating stuff.
Yeah, for sure, Tim. And I think that, how did this all start, this sell-off in rates? If you go back to July when the Treasury met with this advisory committee, they said, OK, you may go above that threshold of 20% in T-bill issuance for a period of time, but then you should consider to move more issuance out the curve because if you issue too much short-term, that deficit becomes very unstable. And so I think this is the dynamic plays out today. A short-term funding for the government to keep open and just finance it with T-bills may not be enough. You have to actually push out issuance out the yield curve, and I think that's troubling the Treasury market currently. So you could expect to see more in the next quarter, the next refunding, to see increased issuance for 10 and 30-year bonds. I think that's being priced in today, as we're seeing right now.
That's interesting, but then you also throw in the possible dynamic that a government shutdown could lead buyers to buy sort of the safety of Treasuries or the U.S. dollar, which is bizarre kind of thinking. But in the past, we have seen that happen.
Yeah, it could be, Melissa. Like as in, most of these shutdowns have happened are short-term effects on the economy, almost like a weather effect, if you will. But it is an uncertainty moment, so it leads then to some level of flight to safety, if you will. And I think if you coincide it with very short-term technical indicators, and you're getting very oversold on ETFs like TTLT with a shutdown overhanging the markets, and that gives you, I guess, scope for this very short-term technical rally that may be in the works. But I think the bigger picture is more about what Tim and I were just discussing. You're dealing with a deficit that's substantial, and you're issuing it with too much short-term paper. So if you have to get away from that, you got to go out the yield curve in terms of issuance. That will continue, I think, be the pressure point for the Treasury market.